Welcome to week 7. This week we're going to take a look at the balance of trade. So we've done a little bit of work looking at exporting and importing and comparative advantage and absolute advantage, but we're going to look at it in week 7 within the context of the function that we've already taken a look at, which is our expenditures model for GDP. So consumption plus investment plus government spending plus exports minus imports. So within this function, we define the balance of trade as the difference between exporting and importing. So this is the exporting and importing of goods and services. So those goods and services that are exported are goods and services that are produced domestically and sold abroad. And those goods and services that are imported are actually produced abroad and then sold domestically. So any difference between exporting and importing would represent a balance of trade. If we're exporting more than we're importing, that would be a positive balance of trade. If we're importing more than we're exporting, we would have a negative balance of trade. So a positive balance of trade is also called a trade surplus. And a trade deficit is defined as when our imports actually exceed our exports. So if our exports are greater than our imports, we will have a trade surplus. And if our exports are less than our imports, we will have a trade deficit. Okay, now. So in addition to looking at the balance of trade, seeing whether we have a trade surplus or deficit within the context of our expenditures model, we also want to analyze what's called the current account balance. So the current account balance, as defined within your text, is a broad measure of the balance of trade that includes trade in goods and services as well as international flows of income and foreign aid. So I've kind of taken some notes on that. We're looking at the balance of trade within the current account balance. So this includes the trade in goods and services, but we're also looking at income payments on returns received from U.S. investors on their foreign investments and returns paid to foreign investors on U.S. investments. So financial investment is just as important as the importing and exporting of goods and services with regard to understanding how this impacts the savings and investment within an economy. Also within the current account balance, we're going to want to take a look at what's called unilateral transfers. So unilateral transfers are payments that are made either by the government, by charities within the economy, or by individuals where no good or service is exchanged. These will generally in the U.S. be flows out of the current account, and they oftentimes represent economic assistance to remedy social inequities. So for example, if the Bill Gates Foundation is spending a lot of money on AIDS vaccinations in Africa, that would be considered a unilateral transfer out of the economy. It's going to be lost to domestic users, that potential capital or cash. So what is financial capital? So we see these income payments being returns that are received on our foreign investments or paid out to foreigners on their U.S. investments. So foreign capital is actually the buying of real estate, companies, financial investments like stocks and bonds, and the returns that are earned on the real estate or those companies or those financial investments like stocks and bonds are the income payments that are either received or paid out. So one thing that we notice is that when we have a current account deficit, this would signify an inflow of foreign capital from abroad. And a current account surplus would signify an outflow of foreign capital to other countries. So therefore, when our current account is in a deficit, so we've added up our balance of trade, our income payments, and our unilateral transfers, we know that we will need an inflow of foreign capital to remedy this deficit that we are experiencing. And we know that when we have a current account surplus, we have more exports than imports. We are receiving more payments than we are paying out. We are maybe receiving more unilateral transfers than we are paying to people. Although I would say that generally we will be in a situation always of paying unilateral transfers out. But our exporting over our importing and our payments received over our payments paid are going to be greater, be a positive number rather than a negative number. This means that we are going to be flowing our capital into foreign countries. So it represents an outflow of foreign financial capital to other countries. We'll be buying real estate, buying companies, and buying financial investments like stocks. When we have a current investment, our current account deficit, however, foreigners will be buying our real estate, our companies, and investing likewise, when we have a surplus, a current account surplus, our domestic citizens or our government will be buying foreign real estate, foreign companies, and investing in foreign capital markets by buying their stocks and bonds. So this leads us to the national savings and investment identity. What we see is that our supply for financial capital must be met by our demand for financial capital. And one way to look at the equation is to notice that where we are savers plus any current account deficit, you can see that the M and X are opposite. So our imports would be greater than our exports here. This would represent an inflow of financial capital, and savings would represent the domestic supply for financial capital. An inflow of financial capital is a supply of capital, and the domestic supply of capital comes in the form of savings. So when we have savings and an inflow of foreign financial capital, that demand is met by the demand that comes domestically for domestic investment. So building factories, investing in human capital, investing in R&D, investing in domestic real estate, even if it's residential versus commercial. That demand for financial capital is part of our expenditures model of GDP. So GDP being consumption plus investment plus government spending and net exports. And then if the government is not spending more than it's taxing, then they will also be demanders of financial capital, as this represents private investment and government spending in excess of tax revenue represents public investment. So sorry if I said that wrong the first time. All of our private investing that's done and all of our public investing is done represents the demand for financial capital, and it's supplied by domestic savers. So you and I investing, saving our money. Any income that we do not spend, we're saving, and it can go towards private investment or public investment, and also any inflow of foreign financial capital is a supply of financial capital. So savings and foreign contribution to savings. If our imports are greater than our exports, this represents financial capital inflows, also known as foreigners buying stocks and bonds, which will be used for private investments or public investments. So these bonds could be U.S. Treasury bonds, or they could be private bonds like for ExxonMobil to go build an oil refinery, for example. So the demand for financial capital is determined by the amount of investment that businesses would like to do, and they're going to be investing in factories, R&D expenses, research and development expenses. They might be doing some human capital investing. And the government is investing in education and roads and scientific research, etc. So the amount of investment that's happening and the amount by which government spending outpaces tax revenues, also known as crowding out, would represent the demand for financial capital. So we might need to manipulate this equation if there are differences in our interpretation of the situation. And this might have been a kind of confusing aspect of the text this week, so I wanted to look at it very closely. If we have a trade surplus, so we know in a trade surplus that our exports will be greater than our imports, that we are exporting more goods and services than we are importing, then we will have savings that's greater than the amount of public investing and private investing. And when our domestic savings, so all the income that we as domestic citizens are saving, not all of it is needed to be spent on education and roads and factories and residential and commercial and real estate, etc., then where does it go? Where will this excess savings go? And this excess exports over imports, or a trade surplus, represents the cash that we are holding and we have in excess. So we will probably buy foreign bonds, foreign stocks, foreign real estate, or foreign companies. Here, the domestic savings is greater than domestic investment. So remember, that cash must go somewhere, and it's probably going to go outside of the country in the form of financial capital investment. So if we have a trade deficit, then our exports are actually going to be less than our imports. So we're going to be importing more than we are exporting. And when we're importing more than our exporting, we'll notice that our domestic investment is actually greater than the savings and the difference between our tax revenue and our government expenditures. So our domestic investment is greater than our savings, and the government here is a borrower, representing a demand for financial capital. When this happens, that cash must come from somewhere. So if investment is greater than savings, the cash must come from somewhere, and it comes from the excess of importing over exporting. So when we're importing a lot and we're not exporting as much, foreigners have a lot of extra dollars. They happen to be US dollars, and what they do is they turn around with that extra money that they have from all of the importing that we're doing. They're receiving dollars. They invest those dollars in US assets, US real estate, US companies and factories. They buy our domestic bonds. They could buy our treasury bonds and stocks. And so that is how we would want to interpret the equation if we're looking at it as a trade deficit. And if we are having a trade surplus, we would want to view the equation in this format. So the book discussed three scenarios that I wanted to take a minute and walk you through. So let's take a minute and walk through these scenarios. So we're going to arrange our equation where we have more domestic investment than we actually have savings for. So here again, what we will be using is this equation. Sorry. we'll be using this equation right here. So we're saying that we have a trade deficit. And this is represented as our imports being greater than our exports. So when our imports are greater than our exports and we have an increase in domestic business investment, where should the funds come from to fund these investments? So if firms are going to go out and build more factories and try to improve their capital, maybe they're going to have new tools and technology to build better products and services for us, and that costs money, where are they going to get the funding to do that? So where we're going to see this happen is we're going to see that there's going to be an increase in our imports. So as our imports increase, the difference between m minus x, or m minus x, is going to grow. And as m minus x grows and we're importing more and more, we're providing more and more financial capital to those abroad. And then those abroad are going to have that cash. They're going to have US dollars, and what they do is they turn around and they buy US companies. They buy US real estate and factories and bonds and stocks especially will allow for more domestic investing to occur. So that's the first scenario. Now, if we're in the same situation where we have this trade deficit, what happens when we have no change to domestic investment, but we do have more private savings? So if we're looking at our equation here, investment minus private savings minus public savings being when our tax revenues are greater than our government expenditures. If we have more private savings, we don't need to do as much importing. So a better way to say this is that as domestic savings rises, there would be less need for foreign financial capital. So a policy proposal can often be made for reducing the U.S. trade deficit by increasing private savings. Therefore, if we want to reduce the trade deficit, to increase private savings. So perhaps this can be done with tax policy. One way that I want to increase my savings is to make sure that I am receiving a better tax return. And one way I can do that is to put more money aside for retirement. So taxation policy can be used to increase private savings, and in the long run, this should reduce the trade deficit. Because, like we're looking at here, if we increase our need for, our demand for financial capital that is used for investing in firms, factories and equipment, etc., then we're going to need it to come from somewhere, and that means we need to export more, because we can't just say, okay, everyone's going to save more and we're going to have more government savings or less government spending. That might not happen. The same is said here, but in a different way. If we want to decrease this trade deficit, we can do it by increasing our savings, because less or more private savings would mean that if it's not being used for investment purposes, that it can be used to reduce our trade deficit. So the last thing we want to look at is the third scenario, where the government budget deficit increased dramatically. So if the government budget deficit increases dramatically and we have this trade deficit, we might see that it actually causes more of a drag on the trade deficit. So if our taxation minus our government spending is actually going to shrink, so our government spending is going to get very much closer to the amount of taxes which we are receiving, then we know that we will need to import more to pay for that. So a good example of this is when we have a trade deficit and we see that the government is spending significantly, so we face a government budget deficit. We're sort of in the midst of this right now. With increases in importing, we're importing more, and it's being financed essentially through the government deficit. And that government deficit will be rising. When we're importing more, foreigners have more US dollars. When they have those US dollars, the way the government is able to spend more is because those foreigners might be doing things like financing that deficit by buying US Treasury bonds, which allows us to spend outside of what we really have access to in the form of taxation. So I just wanted to go over a couple of those scenarios. I hope that they are a little more clear now. And also we've taken a look at some of the important concepts this week. So looking at our trade surplus, our trade deficit, what is the balance of trade, what does exporting and importing mean, what is our current account balance and how do we analyze this, and then also what is this national savings and investment identity. We're looking at the demand for financial capital and the supply of financial capital. And we realize that whether we're in a surplus or a deficit, we might actually have to rearrange these variables to have them make sense. So when we have a trade surplus where our exports are exceeding our imports, we know that savings is going to be greater than the total amount of investing that's occurring. And we also know that when we run a trade deficit, that our investment, our domestic investment is going to be greater than the savings that is being done, and the government is going to become a borrower in this case. So please contact me if you have any questions. I'm happy to help you out with the quiz or direct you on where you should focus for the exam. Thanks and have a great week.